Let's move on with our next section, section 11, which is understanding risk and the cost of capital. The objectives of this section are to appreciate the importance of uncertainty, to be able to distinguish between two different types of risk, and show you what the methods are of incorporating one type of risk, which we'll call specific risks, into the expected cash flows. And then we're going to focus on understanding the cost of capital and learning how to translate systematic risk, another important type of risk, into the cost of equity for public or for private companies. We'll show you then how all of it fits together into calculating a weighted average cost of capital, and we'll help you to avoid some common errors in cost of capital estimation and applications. So, let's get going. We're now focusing on question 6, which is what risks are involved. And we're going to be talking about cost of capital analysis, and then, as we call them, the 3 S's of specific risk analysis: sensitivity, scenario, and simulation analyses. So, I think we all have a pretty solid intuitive understanding that the more risky something is, the less valuable it is. But when it comes to taking that kind of squishy sense of value and translating into specific hard numbers that we can use in our valuation analyses, and do so in a way that if I think one thing and if you think something else, we can at least have a good conversation over, well, hold it, I think it should be this and here's why. That's actually a really big challenge, right? How do we actually do that? And this is one of the times in the program where we're actually going to lean on financial theory. But before we get there, let me start broadly and really sketch out how tricky this is. So imagine for now that you are the CEO of a company. Imagine all of the risks that might be on your mind. As you see in the graphic over here, there could be a range of customer risks on your mind. Demand for your products and services could go up or could go down. You might be thinking about new products. You might be thinking about substitutes for your products. You might be thinking about product liabilities. And that's just a small subset of the customer risks. There's plenty of other risks altogether. What about competitor risks? And competitors get up in the morning to mess with the value of your business. So you've got to be watching them and think, okay, what are they doing to get a leg up on us, and what can we do to get a leg up on them? And are there new products that we can come up with, or is there some consolidation that's going on in the industry, and how do we participate or not in that? Those are some competitor risks. You're also thinking about operational risks. Maybe you have an accident in your production, or maybe there's some risk that technology is going to come along and basically transform the platform of your business. There's also a whole series of input risks. The price of raw materials, the price of labor, the price of transportation could all be going up or potentially down, increasing the volatility in the value of your company. There's financing risks, there's legal and regulatory risks, there's weather risks, there's all kinds of things that could be going on here. Also importantly, there's macroeconomic risks. What happens if interest rates or inflation suddenly go up, or if the business cycle takes a dive? So there's a whole range of risks that CEOs have to be thinking about in managing the value of their businesses. So let's make 2 observations. Observation number 1 is that everything that's on this list is there because it could impact shareholder value, right? Everything here, whether it's a customer risk, if customers go away, that impacts value. If the regulatory agencies come in and put new constraints on the industry, that impacts value, et cetera, et cetera. And then the other observation is that many of these risks are what we call two-tailed, meaning there's not just a downside, but there's also an upside to them. So demand for products could go down, but could also go up. Competitors, you could gain a leg up on them, or they could gain a leg up on you, right? So that many of these things are two-tailed risks. So the conclusions here are, 1, if they all impact value, we've got to find a way to take all of these real-world risks and find a way to put them into our DCF analysis. And then second, risk is really a two-tailed phenomenon. So we're not just looking at a downside, we're looking at upside and downside, and more broadly, the volatility of the value, the full range of values that a company might actually get over time. So another factor comes into play when you take the perspective not of a CEO, but of an investor. What an investor can do that a CEO can't do is he or she can diversify their investment portfolio across many different companies. And you all know what happens here, right? As you add more and more companies to a portfolio as an investor, what tends to happen is that the random good and bad news across the portfolio tends to cancel out. Maybe one company discovers a new product, maybe another company has some sort of accident in their warehouse. And if they're truly random events, across many companies, those random events will cancel out. And so you're going to reduce the level of volatility of the portfolio going forward. The effects of this diversification are strongest when the investments are dissimilar in nature, right? The risks have to be truly uncorrelated from a statistical standpoint, or truly random. Also, most of the benefit of diversification occurs with the first few diversifying investments. And it's also really interesting to note that no matter how many companies you add, there still is some volatility to the overall portfolio. You may well have, for example, an S&P 500 index in your investments. Well, if you do, you've got 500 companies worth of diversification, but that doesn't mean that the risk is zero, right? The S&P 500 goes up and down quite a lot even then. So, modern financial theory really began in 1953 with a man named Harry Markowitz. What he basically did is he made all the observations we just made and then made two important advancements. The first was simply naming. He said, you know what, we're dealing with two different types of risk here, so let's just call it as it is. There's one type of risk that investors can diversify away by putting their money not just all in one company, but in many different companies. But then, no matter how many companies they invest in, there's still some volatility to that portfolio. So let's give these some names. The risks that can be diversified away, he called specific risk, because it's specific to one company or group of companies. And also, the risk that cannot be diversified away is in the system. There's nothing you can do about it from an investor's standpoint. So let's call that systematic risk. So that was his first big advancement, just the naming of specific risk versus systematic risk. But now here's the real rub. His second conclusion, which is actually one of the most important conclusions in financial economics to date, is the following. If investors can get rid of specific risk for almost no cost, will they be compensated for doing it? So let's play with this a little bit further. So, again, if you have $10,000 to invest, you can put it all into one company, or you can put it all into an S&P 500 index. And these days, it costs you absolutely nothing, or just infinitesimally amount, to diversify your money across all of those companies. So, again, if it costs you nothing to get rid of that risk, in a competitive equity market, will you be compensated for bearing that risk? Well, there's two potential answers, yes and no. For sake of argument, let's take the yes side for now. Sure, I'm an investor and I want to be compensated for all the risks of this company, both the specific risks and the systematic risks. So I want a rate of return of, let's say, 20%. Okay? Because if I'm smart enough to diversify my portfolio, hey, that's my good. So I should get the benefit of all that too. So let's say I take that position. Well, it wouldn't be too long before another investor comes along. And another investor would say, well, hold on now. You know, I can diversify my portfolio so that I'm not facing that full specific risk, and it costs me nothing to do that. So I really don't need a 20% return to compensate me for the total risk. I'm happy with, let's say, just a 10% rate of return to compensate me for the systematic risk of the deal. Do you see that if we're both looking at the same company and the company's cash flows, I'm discounting those cash flows by 20%, he's discounting the cash flows by 10%. Do you see that he's going to outbid me every time? And even if I were to hold on to the irrational hope that I could be compensated for specific risks, I'd quickly be bid out of the market. So again, this is one of the most important conclusions in financial economics to date. It's that in a competitive equity market, what Markowitz said and proved was that investors will not be compensated for bearing specific risk. Now, what that isn't saying is that specific risk doesn't impact value. It does impact value. So here's how this works. We can use this to develop a very practical framework to crowbar the appropriate risks in the appropriate places in our DCF analysis. So later on in this section, what I'm going to show you is that if you use any of the common means of calculating a cost of capital, you will only get systematic risk in that cost of capital estimate. Therefore, if specific risk does matter, and it does, then you have to somehow crowbar it into your expected cash flows by using the 3 S's of specific risk, as we call them: sensitivity analysis, scenario analysis, and simulation analysis. You know, if we go back to our original graphic of risks, let's think through which of those risks are systematic in nature and which of those are specific in nature. You know, if you squint at this list long enough, what I think you'll be able to convince yourself is there's really only one category of these risks that's truly systematic in nature. And again, the key distinction here is these are risks that could not be diversified away. You know, all of the customer risks, all of the regulatory risks, all of that, they can do better or worse. And again, across an entire portfolio, you'd expect that they'd be relatively uncorrelated. But the macroeconomic risks cannot be diversified away. No matter how many companies you put into a portfolio, if interest rates go up, the present value of every cash flow in the economy just went down, and there's no way to diversify that away from an investor's perspective. So we'll get back to that when we talk about our systematic risk. But again, for now, let's focus in on the specific risks and the 3 S's: sensitivity, scenario, and simulation analysis. Before we do that, however, I want to, one, share this framework that we're going to be using again from this point onward in this section. But then also, I want to get to a quick quiz to make sure that you're with me on all of this. So assume, for sake of argument, that you're in the consumer foods business and you're considering 3 different alternatives to adding a line of new cookies to your product portfolio. Strategy number 1 is to buy a bakery that already has an established cookie and an established brand of cookies. Strategy 2 is to develop a new cookie internally and then distribute it using a current brand name. And then strategy 3 is to develop a new cookie internally and then to distribute it using a brand new brand name. So let me ask the hopefully simpler question first. Which one of these strategies has the greatest overall risk, total risk? Pretty sure you'll come to the conclusion that strategy 3 has the largest overall risk. Why is that? Because in strategy 3, you basically don't know how well the new cookie is going to do, and you don't know how well the new brand is going to do. Whereas in the first strategy, you know how well both are going to do, and in the second strategy, you at least know how well the brand's going to do. So I think most people can get comfortable pretty quickly with the notion that strategy 3 is the most risky of these strategies. Now let's answer the question at the top of the slide. Which strategy is likely to have the highest level of systematic risk? So what you should be thinking is, as a diversified investor, which one of these strategies is going to add more risk to my portfolio than the others? And this is risk that could not be diversified away by investors. Let me propose a bold answer. The bold answer is they all have the same level of systematic risk. So for the moment, let's assume that that's true. If that's true, and it's also true that strategy 3 has the most risk, what effectively we're saying is that the ways in which strategy 3 is most risky is what? In that it has more specific risks. So let's test that for a second. Does the success of a new cookie have more to do with a company's food chemists and their ability to produce something nifty? Or does it have more to do with macroeconomic factors that cannot be diversified away? Pretty clearly it's the former, right? And similarly, does putting a new brand name in place have more to do with the wherewithal of the marketing department? Or does it have more to do with, what happens with inflation or monthly production? Again, pretty clearly it's the former, right? So if all that's true, what we're effectively saying is yes. All three of these strategies have the same level of systematic risk. Therefore, the cost of capital we'd use for each one of these is the same cost of capital. But now, because strategy 3 has the highest specific risks, we would absolutely adjust the cash flows in strategies 2 and 3 for the additional specific risks that those strategies involve. What we'd end up doing is either adjusting the expected value of the cash flows or the volatility of those cash flows. So hang with me here. First of all, I absolutely promise you this is true. This is one of the most important advancements of financial economics to date. So, it's probably true. The question then is, how do we apply it? And what I'm going to show you first, again, is this framework where we apply specific risk to the expected cash flows, and then we'll focus in on systematic risk and the cost of capital. So, for specific risk, I always like to start broad and intuitive. So, let's say that you have a rather strange backyard in which you have 2 swimming pools. And these swimming pools share the property that they both have the exact same average depth of 8 feet. One of them is 8 feet deep all the way across. The other one is really shallow for halfway across and then really deep for the other half. You dive into the first pool, 100% chance of getting wet. Dive into the second pool, you still have a 100% chance of getting wet, but you also have a 50% chance of breaking your neck. So I hope the obvious intuitive outcome here is that relying on expected value can be hazardous to your health. Pretty simple, right? Well, I'm always amazed at how when you get into financial analysis, this kind of simple horse sense seems to fly out the window. Let me show you just how easily that can happen. So let's say you've done a really good discounted cash flow, DCF analysis, of 3 acquisition opportunities. Acquisition A gives you $10.5 million, acquisition B has a net present value of $6 million, and acquisition C gives you $13.2 million. Given this amount of information only, pretty clear that acquisition C has the highest expected value, so you'd definitely be tempted to invest in that one. But when you look at the next page, you realize what you really might be saying is, do you feel lucky? Because I want you to see that this page is completely consistent with the last page, where we're looking at investment C, which is in red, having the highest expected value of $13.2 million, followed by A, and then followed by B. But what we're showing on this page that we did not show on the last page is this whole vertical dimension. That vertical dimension is probability, and we call these value probability distributions. Because instead of representing value as just one number or an expected value, we're here presenting the full range of potential outcomes as well as the probabilities of each investment, assuming each one of those amounts going forward. One thing's for sure, if anybody does a DCF analysis and they tell you the value of this company based on that DCF analysis is $13.2 million, there's one thing you know for sure. It ain't exactly 13.2, right? If you were to translate that into a probabilistic statement, what you'd be saying is, I'm 100% sure that the value is going to be exactly 13.2 million. There's 0 probability that it could prove to be higher and 0 probability that it could prove to be lower. What a naive assumption, right? You can clearly do better than that. And that's what value probability distributions do. They show you, in this case, that investment C, well, if you're going to dive into that pool, there's a heck of a shallow end, right? And there's a distinct possibility that you could end up breaking your neck. It's a low probability, but it's there, right? And you might want to know that before you dive in. So let me ask you 2 questions. Question number 1. If I constrained you to saying you're going to either make 100 investments in C, 100 investments in A, or 100 investments in B, and assume you have the capital to do all of that, which one would you choose and why? Now, if you're going to do 100 of these things, I'm pretty sure that you'd ultimately choose to go with investment C. And here's why. Sometimes you're going to roll snake eyes. And who knows, the value could be worth even as low as -5 million, as it shows here. Sometimes you're going to roll boxcars, and it could be up to 16 million. But on average, across 100 different roles, you've got to assume that the law of large numbers is going to prove out, and that the higher expected value associated with investment C is going to prove true. It'd be really strange if that didn't happen after 100 investments. You'd have to be very, 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 very unlucky. So given all that, I think you could say, yes, let's go with investment C if you're going to do 100 investments. But now let's go to the trickier question. What if you're only making one investment? What if you're really betting the company on this? Do you see that in this situation, realistic people could come up with different conclusions? You know, just as on a hot summer's day, if you're mowing the lawn, you're super hot, you know the pool has a shallow end, you might still decide to dive in if you felt you could dive shallow or somehow avoid breaking your neck. You might decide to do that. But also, a rational decision would be, heck no, I'm not diving in that shallow pool, forget it. So reasonable people can disagree in this situation if you're betting the company. You know, is the additional expected value of $3 million or so over investment A worth the additional risk involved in investing C? What doesn't do you or your company an awful lot of good is to present the analysis as we did on the prior page and say, well, C has the highest expected value, but then after the fact say, oh, well, I always knew there was more risk and uncertainty associated with it. Right? That's not particularly helpful. Too little, too late. So what I hope is starting to become apparent is that it could be useful to understand this notion of risk. What's not apparent right now is, well, how the heck do you do this? And what I'm going to show you is there's 3 methods, and it's actually much simpler than you might think to gain this type of an understanding of risk. So again, here we are. We're going to talk about sensitivity, scenario, and simulation analysis. Let's take a look at sensitivity analysis. Sensitivity analysis identifies how additive, multiplicative, or range changes to each value drivers impact value. And it's really easy to do. What you see on this page is exactly from the valuation toolkit. There's a worksheet in it called sensitivity analysis, and all you have to do is enter the ranges you want to explore, and what it'll do is it'll change the value drivers as you direct it to, and it'll show you how much value changes for each one of those changes. Now there's actually 3 different ways of doing it. There's additive, multiplicative, and range changing. Let me just say a little bit about each one. Additive is probably the one that most people think of first. It's let's take each value driver and add or subtract 1%, 2%, or some fixed amount. What's great about that is that's actually really helpful for negotiations, because no matter what happens, whoever's on the other side of the table probably isn't going to agree exactly with what you are going to use for sales growth or for margins or other things. So if you have that sensitivity, you'll know how much each point of sales growth, each point of profits is going to be worth. So that's one of the most common approaches to sensitivity analysis, which is the additive. But you might also say, well, hold it. You know, adding 1% to a profit margin of, let's say, 10%, that's 10% change. But adding 1% to 35% tax rates, that's really only a 3% change. So do you see how additive is kind of unfair when you apply it across variables of different magnitudes? To get around that, you can use the multiplicative approach, which basically multiplies each value driver by, let's say, 1.1 or divides it by 1.1 so that the differences in the means of the variables don't matter. And it gives you the most pure sense of, well, which driver has the biggest impact on value. And then finally, there's range sensitivities. If you want to say, well, hold it, here's what the value would be if margins were as low as this or as high as this, simply enter them in the range. So as you see here, simple to calculate. It's trivial, it's done for you, it's in the worksheet. Really valuable to do. And it also varies a lot by company. Some companies, such as grocery stores, are hugely sensitive to changes in profit margins. The basic idea is they earn so little on each additional sale that you can increase the sales by quite a lot and not create a lot of value. But if you can increase the margin they're getting on their sales, you've created a huge amount of value. Other side of the spectrum, there's businesses that are like jewelry stores. Jewelry stores, enormous profit margins, right? So change profits from obscene to obscene plus 1, and you haven't created all that much value. But if you can change the base over which you're getting those large margins, a lot of value's had. which is why, although I've been married for 20 years now, I still get these really expensive catalogs from the place I bought the ring, because the sales growth is the big driver for businesses like that. So the point is, many businesses are different, and doing this sensitivity will give you a sense really quickly for what kind of company you're dealing with. Let's take a look at what kind of company we're dealing with Gleason. So what we see on the left is the multiplicative, in the middle is the additive, on the right is the range. Well, they all basically say the same thing. This is a company that's much more like a grocery store than it is a jewelry store. Changes in profit margins have a big, big impact on value. And again, that's really important to know, because what that does is it kind of leads you to the framework you see here. You can identify the value impact from sensitivity analysis, and then you ask yourself, well, which ones of those variables can we truly influence? And for things like profit margins in this case, it is both high value impact and also very high ability for management to do something about it. There are other variables, though, that are not in that quadrant. So take, for example, the cost of capital. If the cost of capital isn't the most important value impact value driver, it's always within the top 3. But as we're going to see when we get to the cost of capital section, the cost of capital isn't something you can do an awful lot about, right? It's kind of a given to you from your investors. So that would be down in the hedge and monitor category. So sensitivity analysis is so helpful, so useful. We do it 100% of the time. There's no excuse for not doing it. On the other hand, it doesn't do everything. I mean, while it starts to sketch out, okay, if this value driver were lower, here's how much value would go down, and if it were higher, here's how much it would go up. So we're doing a little bit of motion on what's the range of values the company might assume. But notice it does nothing at all on the vertical side. What's the probability of those things actually happening? To do that, we need to move on to our next S, scenario analysis. Scenario analysis is fundamentally different. Instead of just mechanically changing each value driver, here we go back to our list of risks and choose, I'll say, 3 to 5 of them that we think are most likely to happen and that would also have the biggest impact on our value. And then we work through not just the impact on each value driver in isolation, but we say, if that scenario happened, what would happen to sales growth, to profit margins, to fixed and working capital, taxes, etc. And then we calculate a value that would occur in that scenario. Then, for the first time, we start working on probabilities. We start to say, well, what's the probability of that event really happen? And the more of these scenarios you do, the more you'll start to sketch out both the range of values that the company could assume and the probability of getting to each one of those values. And again, so estimating probabilities can be a little bit tricky, but there are some things you can do. You can look at the historical occurrence of these events. So for example, if you're trying to predict what's the probability of a new competitor entering the industry, simply look to how many have entered over the last 5 years. Then you might also ask yourself, well, why is it that the future might be different than the past? So there are some things you can do. You can also, review industry trade journals or speak with current industry experts. Pretty much anything is better than the extremely naive assumption of saying, we're 100% sure that this company is worth exactly $13.2 million. Again, pretty easy assumption to improve upon. So let's show how scenario analysis could apply to Gleason breweries. Let's assume that there's a base case scenario which has a 50% probability of happening, where the company is worth $576 or so million. Then, let's take another scenario, the scenario where a new competitor enters the industry. If that were to happen, that's bad news, right? If that were to happen, you might expect that sales growth would go down, in this case by 2%, and we also might reduce our margins by 1%. And that has the impact of reducing our value to $500 or so million. And let's say there's a 25% probability of that. Then let's look at another scenario. We've talked about the possibility of investing in aluminum can packaging. The good news about that is that would improve our profit margins, but it will cost us something in terms of increased fixed capital expenditure. Net, when we do that, though, we see that the value goes up to $624 million. So do you see that the more scenarios you do, the more you sketch out the range of values of the company, and importantly, you start to sketch out the probabilities of it assuming each one of those values. So this is an extremely important analysis to do because it proactively helps you to identify the risks and think through, hey, here's what we would do to optimize value in each one of those. And as we said, it also gives you a much more realistic representation of the value probability distribution as you do more and more of these scenarios. One problem, though, is it's actually difficult to do a large number of scenarios. Usually by the time you've done 3 to 5 of these scenarios, you're done. Because estimating the probabilities of each of them happening individually is pretty tricky. Entering the probabilities of each of them happening in combination gets really, really messy really, really quickly. So again, really good for identifying and planning for the key risks that might happen. Let's then move on to the third of our specific risk analysis, simulation analysis. What simulation analysis does, in short, is instead of doing what we do in our valuation toolkit, where we enter a hard number for sales growth, let's say 8%, and a hard number for taxes and profits, and a hard number for fixed and working capital, instead of those, you actually enter a distribution. So rather than 8%, maybe you enter an expected value of 8% with a normal distribution and a standard deviation that means that, within 2/3 of the time, the sales growth will actually be somewhere within 2 percentage points of 8 percentage points. So you're entering a distribution for each. Then what there are programs that can do is they then randomly select a sales growth from the sales growth distribution, randomly select a profit margin from the profit distribution, and so on, and then calculate a value for a company. And then, if it does it once, it can do it 1,000 or 10,000 times. And so what it basically does is, by all of this sampling across all those distributions, it basically does a frequency distribution of the values, which then ends up representing the value probability distribution for the company. Now, you might appropriately be a little concerned here. Anytime a computer goes off and does tens of thousands of calculations, you got to scratch your head a little bit and say, well, hold it, does this really make economic sense? But remember, all we're trying to do here is improve upon what is ultimately a very naive assumption, which is that we're 100% sure that the value is going to be exactly this number, or we're 100% sure that sales growth is going to be exactly 8%. Come on, get real, right? You're never that certain. So why not do a better job of representing the true uncertainties as you understand them to be? You can actually look to what has been the historical volatility of sales. What's been the range and standard deviation of profits or taxes or other things that you've seen in the past. So this is actually a really, really powerful tool, and there's actually a range of computer software products that are available that will allow you to do this really quite easily. My personal favorite is one called Crystal Ball. It's basically an add-in to Excel. You put it in there, you can enter into any distributions, it does the sampling and generates these value probability distributions. And so what you end up with, if we apply it now to Gleason Brewing, is that if you undertake the national strategy, that definitely has the highest expected value, but it also has greater risk. Although the expected value is 737 million or so, there's significant probability that it could be much higher, and also significant probability that it could be much lower. The regional strategy, as we talked about in our strategic fit section, has a lower expected value, but it has a tighter range of values. Why? Because you're more certain about that. That's closer to what you're currently doing. But if you actually look at it here, the probability that you'd end up doing worse by choosing the national strategy versus the regional strategy is virtually nil. So the risk analysis tends to underscore the notion that undertaking a national strategy with Gleason combined with Asso Bronx is a smart thing to do. So let's summarize what we've talked about with respect to the 3 S's. First, sensitivity analysis is fantastic for assessing the relative impact of variables, and it's super easy to use. But it doesn't tell you anything about the probabilities of the company actually assuming each one of those values. Scenario analysis is fundamentally different. You identify 3 to 5 key scenarios that could happen, and then not just look at each variable in isolation, you look at all of them at once and say, in this scenario, how would they all change, and how would they ultimately impact value? And then importantly, what's the probability of that scenario actually happening? So again, scenario analysis, super important. We do it virtually all the time. And then the third approach here, simulation analysis, it turns out that the same models that do all that sampling do the relative impact analysis for you, just as sensitivity analysis does. But in addition, you can capture the interrelationship between variables. It's appropriate for using big differences in each variable, and it's actually much easier to use than you might expect. And very importantly, it gives you the most robust understanding for the value probability distribution. And that's really important because when we get into negotiations analysis, what we can say is, well, look, we don't want to choose a price that would leave us only a 50-50% probability of creating value. Maybe we choose a price that's a little bit lower so that we have a 60%, 70%, or even 80% chance of creating value. Simulation analysis tells us how far we need to go down in our price to achieve those probabilities. So you're going to be seeing more of this into the future, so I wanted to make sure that you are familiar with it. So that then ends our conversation of specific risk, how to adjust the expected cash flows, either the expected value or the volatility of the cash flows by using sensitivity, scenario, and simulation analyses. Let's now move on to systematic risk and talk about the cost of capital. So the cost of capital is the weighted average return that investors expect given the risks of the company. And because in general there's 2 basic classes of investors, debt holders and equity holders, and because debt holders have a prior claim on the assets and therefore less risk associated with their investment, in calculating the weighted average cost of capital, you need to consider that investments will be funded with a blend of debt and equity going forward, so we use the weighted average. Let's take the cost of equity times the percentage of equity that's going to be used in the capital structure going forward. And then to that, let's add the after-tax cost of debt times the percentage of debt in the capital structure going forward. So that's basically it. Pretty simple weighted average calculation. So, in order to calculate the cost of capital, you only need 3 things. You need a target capital structure of debt and equity going forward. You've got to estimate the cost of equity, and then you have to estimate the cost of debt. You do that, you can calculate a weighted average cost of capital. So let's start with capital structure. So, a company's financing can come from a whole range of different investors, and the weighted average cost of capital should not be just the percentage of debt and equity, but if there's preferred stock, you should include the percentage of preferred times the cost of preferred, or if there's leases, you should be the percentage of leases times the cost of leases. It can get much more complicated. But again, it should be the weighted average target blend of all your financing sources going forward. So, in calculating the specific capital structure, you need to look at the market value of debt and the market value of equity. And if you're buying a company, you've got to think through, well, what's the appropriate financing for this target? It may be different than the overall financing for your company. It may not be, but it might be. So whatever your target intended blends of debt and equity are into the future for this business, that's what should be used if you're saying this will be the value of this business to us the way we're going to finance it going forward. So that's the simple answer. Of course, you'd like to use market values instead of book values for debt, and especially equity. Book equity values can be very old and out of date and not particularly appropriate for use in this. But then that creates a problem. What if what you're buying is a private company, so you don't have a public equity value to operate under? Well, you can see we kind of get into this chicken and egg thing here, because what you need is a capital structure to calculate the cost of capital, but you need a cost of capital to calculate the value of equity, which is a part of the capital structure. So what's the easiest way to get around this? Simply start with a guess. Use a multiple to come up, or some other simple approach to come up with a simple first pass estimate of what the equity value is. Use that to calculate your capital structure, and then use that to refine your estimate of value. Then use that refined estimate value to update your equity value in your capital structure, and that'll give you a new value. By the time you've gone through this process once, or at most twice, I guarantee you're going to end up with a stabilized and appropriate capital structure to use for your business going forward. So that's just a quick way to get around this issue of how do you determine a capital structure for a non-public target. And we've shown an example of that done here on the next page for Gleason Brewery. So now let's move on to the cost of equity. So cost of equity is actually pretty tricky. You know, it's not enough to ask equity holders, well, what rate of return do you expect? Because an equity holder would always say, well, I'd prefer more return, thank you very much. And so you can't ask them. Instead, you need to observe what they actually do. And so let's observe. These are the actual returns to the S&P 500 between 1927 and 2017. And notice they're really high in some periods, they're really low in other periods. But on average, between 1927 and the end of 2017, they've offered on average about a 10% return to investors. And furthermore, if you see no huge flights of capital into the S&P 500 or huge flights of capital out of the S&P 500, you can assume that whatever that rate of return is, it's sufficient for compensating investors for the risks that they feel they're facing in the S&P 500. So there you go. What's your cost of equity? On average, 10% is actually a pretty good answer. But come on, we can do a little better than that, and let's do. The next question is, well, isn't it true that some investors require more return for some companies than others? And of course, the answer is yes, they do. Investors require higher returns on equities that are more sensitive to market movements. So what does that look like? So, I think, again, if you scratched your head, you'd probably come up to something that's really close to what Sharpe, Lintner, and Trainer came up with in the capital asset pricing model. That's what we're now going to discuss. But again, the only reason we're going to discuss it is it leads to a practical answer you can use for the cost of equity. So, here's what they did. They said, well, I don't know. Let's see how a given company moves with respect to the changes in the market. So maybe 1 month, the market does really well, and the company does really well. So let's put our first red dot up here. Then maybe another month, the market does really poorly, but the company also does really poorly. So then we put our second dot out there. Then we put our third and fourth dots down, and so on and so forth. And then we end up plotting the best fit line across all of those points. And what that line then represents is, on average, when the market moves 1 unit, here's how much this stock moves. And of course, if we look at this across all companies, because the market has to move with itself, the average slope of this line has to be 1, right? Because the market moves with itself. But that's not the way it always turns out. For specific companies, sometimes every 1 movement unit in the market results in, let's say, 2 units of movement in the stock price. Those companies are more risky, right? Because no matter what happens in the market, they have kind of a leveraged return. Then also, some companies are less risky than average, where for every 1 unit in the market, there's only half a unit movement in the stock price. Those are more those are more safe companies. So what Sharpe, Lintner, and Trainer did is they said, okay, here's the capital asset pricing model. Let's take our cost of equity and not just say it's 10% for everybody. We're going to say it's first a risk-free rate, which is the rate of return that an investor could get for taking no market risk at all. So to do that, you can look at government securities of similar duration. We'll talk about that in a minute. So you take a risk-free rate, and to that you add a market risk premium multiplied by something called a beta. Sounds pretty impressive, huh? But hold on. What's a market risk premium? Well, the market risk premium is just the difference between the expected average return and the risk-free rate. So if you add the market risk premium to the risk-free rate, you get roughly the 10% number. So all we're really saying here is the cost of equity is pretty close to 10%, where the market risk premium is multiplied by this beta. But what is beta? It's simply the average slope of this line. And we also know that the average slope is 1. So if we multiply the market risk premium by 1 and add the risk-free rate, do you see that we're still just basically saying, look, the average cost of equity is 10%. But again, it doesn't always turn out that way, because betas can be as high as 2 or as low as, let's say, 0.5. You end up with a range of costs of equity which represent each company's unique exposure to market movements. So the maturity of the risk-free rate should match the term of the cash flows from the business being valued. And because we're valuing based on long-term cash flows, and for example, a no-pat perpetuity is absolutely the definition of long-term, you'd also want to use a risk-free rate that goes into the long-term. In the US right now, a 10-year bond is a good representation of what that long-term risk-free rate might be. So we take the expected market return of 10% or so, we subtract off the risk-free rate, and that gives us an expected market risk premium of 7% or so. No big surprise. And again, because the slope of that security market line is the beta, and the average beta across the market has to be 1, because the market in general moves with itself. So again, we're really just saying that on average the cost of equity is still 10%. So super fancy model, Sharp, Lintner, and Trainer, they shared all kinds of awards for coming up with a capital asset pricing model, but it's really not that much more sophisticated than what I've just related here. The good news is you can use betas to calculate the systematic risk level for companies. And you can find these betas really easily these days. Just go online, go into Yahoo Finance, you can look at Valueline, you can look at S&P, you can look at Bloomberg, you can look at OneSource. There's all kinds of appropriate sources out there for betas. What I need to do though is also kind of prove to you that you will only get systematic risk if you use betas. So think about it this way. Imagine for a given company that there's a security market line that looks on average, let's say like 1. So let's say that 1 month the market did reasonably well, but the stock did less well than you would have expected given what happened in the market. The question is, what could have caused that to happen? And a quick answer would be, well, something bad must have happened to that specific company. Who knows? Maybe they had an accident in a warehouse or something like that. Would that have impacted the value of their company? Yes, it might have. Would it impact the value of the market or the return of the market? Not at all. So specific risk is why those points might be off of this line. Similarly, let's take a positive example. Let's say the market didn't do particularly well in 1 month, but the company did quite well. What could have happened there? Again, maybe that specific company could have come up with a new product, or something good happened to them that would impact just that company, but not impact the entire market. So do you see that the very process of plotting the best fit line through all of those points naturally diversifies away the specific risk so that all you get in a beta is systematic risk? It's even stronger than that. Beta is the definition of systematic risk. So there is no specific risk in a beta. There never will be specific risk in a beta. So if you use the capital asset pricing model or other theories such as arbitrage pricing theory or other common approaches to calculating the cost of equity, you will only get systematic risk in those numbers. That's why it's so important to do the specific risk analysis that we started with in this section. So, while betas do average to 1, they do vary quite a lot across industries, which you see here. So you say, okay, got it. I now understand how you come up with the cost of equity for a public company. You look at their stock price and see how it changes vis-a-vis the market. But what if you're dealing with a private company, or you're buying a target that's not publicly traded? Well, in that situation, what you can do is look at the betas of publicly quoted peers and average those betas to come up with a proxy for what the beta would be for that private company. Use that to calculate the cost of equity and use that in your cost of capital calculation. Pretty simple, right? Well, as it turns out, there's yet one more thing you need to think about. What if it's the case that those peers are leveraged at a different amount than you would be leveraging the target going forward? It turns out that does matter. The amount of debt in the capital structure absolutely impacts what the betas are, or what the cost of equity is for a company. So let me see if I can generate some intuition around why that might be true. So what you see here is a situation where we have a company, let's say that its value is proportional to the size of this blue box here. Let's say the overall thing is worth $100 million and that you own 50% of it. Let's also assume that the value could go up or down by $10 million. So your share of that business could go up or down by $5 million because you only own half of it. The other equity investor has the exact same risks. Now let's take the exact same company but finance it a different way. Let's now say you own 50% of the company in equity, but let's say the other 50% now is a debt holder. They own $50 million there. But what's different is that on the debt side, because they have a prior claim to the assets and to the value of the firm than the equity holders, as the value of the company goes up and down that 10%, the debt holder's claim stays solid at $50 million. But that $10 million volatility still remains. So now you own $50 million, but you're facing that full $10 million volatility. So your respective volatility has gone up from 10% to 20%. So what we're actually talking about here is Miller and Modigliani's second proposition, which basically says, look, a company is as risky as it is, and it's owned by whoever owns it. So if you put more debt holders in there and they're insulated from the risks to the equity holders have to go up. How much? Exactly enough to offset the additional amount of debt in the capital structure. So it does turn out that debt impacts the cost of equity, and therefore you have to do what we see on this page. You have to, what we call, re-lever the betas of peers. And by the way, this is about as dweeby as we're going to get in our financial conversations together. But the basic idea is, if you've got a bunch of peers where they're levered highly, meaning they've got more leverage in their capital structure than the way that we're going to run the business going forward, if we just average those betas, we'd end up overstating the amount of the cost of equity. So instead, what you need to do is unlever those peer betas and then re-lever them to the target capital structure the way we're going to run that target company, and then use that average re-levered beta to come up with a cost of equity to use in discounting the cash flows from that company the way we're going to run it. So it turns out that there's actually a formula for doing this. It's called the Hamada re-leverage algorithm. I don't care at all that you memorize what this formula is. And importantly, it's actually baked into what's called a peer group beta spreadsheet that's in your valuation toolkit. So it's already there. You don't need to memorize this or do that. But I do care that you memorize why you're doing it. Again, if the capital structure of the peers is different than the way you're going to run the business, you need to, as we call it, re-lever the betas. So here's what that spreadsheet looks like. You simply enter the public peers, you enter their betas, and you enter their current leverage and tax rates if you know them. And then you enter the target capital structure of the business the way you're going to run it. And then what the model does, based on the weights that you provide, is it comes up with the weighted average re-levered beta, which you can then use in your cost of equity calculation, as we've shown here for Gleason Breweries. You take the relevered average beta, you multiply it by the market risk premium, add the risk-free rate, and we end up here with a cost of equity for Gleason of 7.69%. Just that simple, huh? All right, well, let's move on to the cost of debt. Cost of debt truly is much more simple. The cost of debt is the weighted average after-tax expected return required by a company's debt holders. The market value of debt is something that you want to focus on rather than the book value wherever possible. And you want to use a long-term fixed rate, even if there's swaps or the pricing is based on LIBOR, because a long-term fixed rate represents the period-by-period rates that would actually apply over the period of the debt. So to calculate the after-tax cost of debt, you take the pre-tax cost of debt and multiply it by 1 minus your cash tax rate. As a quick example, if we've got a private company's pricing for their debt is 3-month LIBOR plus, let's say, 175 basis points, and the swap rate is 5.85%, and you assume a marginal cash tax rate of 21%, you can see here you end up with an after-tax cost of debt of 6%. When we show this calculation for Gleason's, they have some of their debt is short-term. Most of their debt, though, is long-term. If we average the yield to maturity and take that weighted average, we see that their after-tax cost of debt is 6.55%. You can put all this together in the toolkit under the value driver sheet. There's a cost of capital calculation, as we've shown here. You put all the cost of equity in there, the risk-free rate, the market risk premium. You put in the debt, you put in the tax rate, and what you put in the leverage. And what it shows you is that's how you end up with a weighted average cost of capital of 7.64% for Gleason Breweries. So we've just discussed an internally consistent framework for taking all risks, systematic and specific, and crowbarring them into the cost of capital. We've shown you how specific risks are adjusted for in the cash flows, and systematic risk naturally resides in the cost of capital. However, it's common practice in some markets to put both systematic and specific risks into the discount rate. And I really understand why they do that. So, for example, in investment banking and in venture capital and in real estate, it's common practice to add a premium to the cost of capital for the specific risks. So instead of wanting, let's say, a 10% return, they want a 20 or 30% return. Well, think about it for a second. If the cost of equity is going to be as high as 20%, even just 20, what would your beta have to be? Right? At a market risk premium of, a little over 7%, your beta is going to have to be over 2.5. And let me tell you right now, you're just never going to see betas that are that high. So a little flag should go up in your head. Anytime someone is using a cost of equity that's 20% or more into the future, what they're doing is they're adding a premium to the true cost of capital for the specific risks. And again, I understand why they do that. So for example, if you're an investment banker and you're wanting to work with a company to help them to sell, and they give you a forecast of their business, the conversation you don't want to have with them is, oh, those cash flows you gave us? We really don't believe that they're going to come true, so we're going to take a 50% haircut on those cash flows and then discount them by the cost of capital. Well, if you're their client, you might say, well, who are you? I know my cash flows better than you do, so, I'm not too sure I want to work with you. So to avoid that rather unpleasant conversation, what investment bankers do is they say, absolutely, we love your cash flows just the way you've given them to us. We love the company. We're just going to say that we're going to require a 20 or higher % return on that. And if the company isn't too well versed in systematic risk analysis, they may not pick up on the fact of what they're really saying is they don't believe your cash flows at all. So because different markets work that way, and again, let me give you another example, real estate. In real estate, they use what's called cap rates, which are basically the true cost of capital plus the specific risks that are associated with a certain type of property. So if you want to build a bridge between that approach and the approach that we've been talking about, here's what we recommend you do. First, do all of the analysis exactly the way we talked about, right? adjust the cash flows for specific risks, adjust the cost of capital for systematic risk, and calculate a good number for value. Then take that number for value, reinsert the unadjusted cash flows, and then solve for what the discount rate would have to be to get you to that value. At least if you do that, you're certain that you're adding at least the right amount of premium for the exact specific risks that you anticipate. So that's a way of building a bridge between the internally consistent and theoretically appropriate approach that we've demonstrated here for using risks and incorporating them into the cost of capital, and approach that you might see in investment banking and elsewhere. So this is an application of what we call the matching principle, which basically says that the risks that are reflected in the cost of capital have to reflect the risks in the cash flows being discounted. It's just that simple. So if you've adjusted, as you see down below, if you've adjusted the cash flows for specific risks, then you can use a pure cost of capital in the discount rate and you'll be fine. On the other hand, if you haven't adjusted those cash flows for specific risks, you do need to add a premium to the cost of capital for those specific risks. Another example of the matching principle is on the tax side. What we've shown is that you don't include the tax advantage of debt in the cash flows. Instead, you use the after-tax cost of debt in the cost of capital. That's internally consistent. Then if you go on to the entity side, if you're discounting corporate cash flows, you want to use a corporate cost of capital. And if you're discounting divisional cash flows, you want to use a divisional cost of capital. And importantly for acquisitions, if you're using the buyer's cash flows, you want to discount them using the buyer's cost of capital. And if you're using the seller's cash flows, you want to discount them by a seller's cost of capital. So really important to follow this matching principle. And that leads us into what are some of the common errors involved in cost of capital estimation. The first one is adding extra points to the cost of capital just to be safe. So the way this one sounds is something like this. So let's say you do the right calculation for the cost of capital and you end up with a number of 10%, but you want to be extra sure that you're going to create value. So you say, well, let's only accept projects that offer returns of, let's say, 14% or above. So you've added a 4% premium to the cost of capital. And that sounds nice and conservative, doesn't it? But then ask yourself this: if you do that, what investments are you going to be accepting over time? And it turns out that if you only accept investments that offer returns of 14% and above, on average, those are going to be more risky investments. So the ironic outcome of this conservative assumption is you're actually steering the company toward greater and greater risk over time. So no bones about it. The best thing to do: estimate the cost of capital based on systematic risk and leave it alone. Don't add a premium, don't take a discount, just leave it there. Anything you do to it is going to mess up the financial economics and the valuation estimate that you're trying to create. Second common error: evaluating target companies using the acquirer's cost of capital. That's a violation of the matching principle, right? So let's assume, for sake of example, that we've got a company that is an aerospace company, and they're buying a dog food company. Now, it turns out the dog food companies are much less risky from a systematic standpoint than aerospace companies, because dogs eat no matter what happens in the economy, right? So let's say that an appropriate cost of capital for dog food is 10%, and an appropriate cost of capital for aerospace is 14%. Well, do you see that if you used the acquirer's cost of capital of 14% to buy the dog food company, you would be undervaluing that company and you'd probably end up being outbid. So, dog food cash flows, use a dog food cost of capital. Aerospace cash flows, use an aerospace cost of capital. That's the matching principle. Another related error is to use a single company-wide cost of capital to discount cash flows from divisions that have different levels of systematic risk. So continuing on with our example, let's assume now we have a business that's 50% dog food and 50% aerospace. You might say, well, let's just use a 12% cost of capital for all of that. The problem with that is, if you're in the dog food division, you're going to have a really hard time finding dog food investments that earn a 12% return, because on average, they only deliver a 10% return. So you're going to be starving out that safer business, the dog food. On the other side, your aerospace business, hey, they're going to have a real easy time finding aerospace investments that give a 12% return, because on average they give a 14% return. So you're going to be systematically over-investing in your risky divisions and systematically under-investing in your safe divisions. So again, the way out of this, follow the matching principle. Dog food cash flows, dog food cost of capital. A related issue here is assuming that leverage is constant across divisions. Even if you're really solid on what your overall capital structure is, it might well be that capital structure should be different for different divisions within the company as a function of the magnitude and volatility of the cash flows that are expected. And as we've seen, that impacts the cost of capital, and that impacts, therefore, the value. Another common error in cost of capital is using cost of capital rates that reflect total risk rather than just the systematic risk that investors can diversify. Excuse me. And then also, using the cost of specific financing as the cost of capital for investments can be a real problem. So here's what this sounds like. So let's say you're making an investment in a company and you're getting the financing from a bank. You've went to the bank and they said, yep, we're happy to give you all the money you need to, let's say, make this new investment, and we're going to charge you an after-tax rate of, let's say, 5%. So you take the cash flows from that investment and discount them by 5%. Question, have you made a mistake? The answer is, yeah, you have. But the way to think about that is this. What if, instead of financing that with a bank, you decided to finance that from the equity markets? Then the rate of return required wouldn't be 5%, it might be 10 or even higher percentage points. And so you're just an operating manager trying to figure out what's the best thing to do. Should you invest in this or should you not? And if you invest in it based on debt financing, it looks great because you're using a lower discount rate of 5%. And if you invest in it with equity, it looks terrible because you're using a much higher discount rate. The way out of this is we need to avoid this mixing of investing and financing decisions by using the weighted average cost of capital for all investments. So independent of the cost of specific financing, if you're going to be tapping equity markets and debt markets in some target blend going forward, that's the rate you want to use for each and every investment so that you don't mix up your investing and financing decisions. And then the last common error is using book weights rather than market weights in determining your capital structure, in weighting the cost of equity and cost of debt in the weighted average cost of capital. So, my goodness, we've been through a lot together in this section, haven't we? The summary of this section is that there's two basic categories of risks that impact value. Specific risk, that are risks that can be diversified away by investors and are adjusted for in the expected cash flows. And then there's systematic risks that cannot be diversified away by investors, and therefore investors require compensation for them in the cost of equity. So you need three parts of information, three pieces of information in order to calculate the cost of capital. You need a target capital structure, you need a cost of equity, and an after-tax cost of debt. And the cost of equity reflects the systematic risk of the business to be valued, and the best way to calculate that is using the capital asset pricing model developed by Sharp, Lintner, and Trainer. And it says the cost of equity equals a risk-free rate plus the market risk premium times a beta. So that's what we've done in this section. Let's now test your understanding of all this by calculating an appropriate cost of capital to be used for Himalaya Dairy.